Hello everyone, greetings from Akshay Money Works for You. My name is Sushant Zadav. I'm a relationship manager at Akshay Money Works for You. And today's topic of the video is, should I invest everything in small caps? Because as we see, investors often normally are attracted towards small cap funds because small cap funds returns are very spectacular. They are double digit returns, and sometimes investors wonder that whether they should allocate a higher number of their amount of their total portfolio in small cap funds, or should even the entire portfolio be concentrated in small caps. So this is the topic of discussion today, and let's continue with it. So basically, let's first understand what are small caps. As per SEBI classification, a small cap company is one that ranks from 251 onwards in terms of market capitalization, and a small cap fund is a equity mutual fund which is mandated to invest a minimum of 65% of its total AUM in small cap companies. So, what is it that makes this small cap companies so attractive in the first place? So, the thing is, the small cap companies have a large potential of growth. They are often companies which have only been recently listed, or unlike mid and small cap companies, these companies are in a nascent stage of business compared to the large and mid caps. So, there is a lot of growth potential to be unlocked there. They have a high potential for rapid business. Their earnings growth is dynamic compared to mature businesses. For example, if we see the earning growth and potential for Zomato is much more than for a mature company like Hindustan Unilever. And there is a greater room for companies to scale operations, improve their margins, capture more market share, and that is what makes the small caps so attractive. And they also have one of the key thing that we can say which works in their advantage is their potential to scale and become tomorrow's mid and large cap companies, and thus provide great returns for investors. So even if we have to see as an example, let's look at these two small cap companies which have just performed fabulously. So if we see this Gabriel India companies there, which has given roughly 460% in 3 years, Apollo Microsystems, which has given around 576% in 3 years, and there are many more small cap companies which such robust returns are the ones that attract investors in the first place. But however, past performance is not an indicative of future performance. So enough talks about the small cap returns. Now let's take an understanding of how small cap risk is, and what are the dangers, and what is the actual reality behind these three double digit returns. So there is a very key factor here that investors often overlook, and that is the market volatility. Small caps are extremely vulnerable to short term volatility. They can experience sharper standard deviations than large cap. Small caps are more vulnerable to short term fluctuations than large cap. They are comparatively more volatile in that sense. We will discuss an example regarding it in the coming slide. And while the drawdowns that happen, the falls that happen in small caps is not a thing that is unknown to equity. It does happen, but one must be prepared for the comparatively big drawdown that can happen in small cap. The objective of a successful portfolio management system, or in order for an individual to build a good portfolio, it is not that he has to avoid small caps. Instead, he needs to understand the risk that small caps have, and he needs to take into consideration his time horizon and his risk appetite regarding it. So let's go through a brief of how the small cap index has performed in the last decade. So let's look at a chart of the Nifty Small Cap 50 index. So as we can see, the point of market volatility that I mentioned in the previous slide. So as we can see in the 2008 crash, when the Lehman Brothers crisis happened and the housing bubble burst, we can see that the small cap index crashed roughly 75%. That's a lot of volatility if we can see. And a person who might be a conservative person, or a person who is unable to digest such a volatility, So he needs to take into consideration that not only there are the attractive returns of small cap index, but in case of a black swan event like this one, this downside can also occur. And then if we see for the time span of 2011 to 2015 or 14 roughly, the small cap index has been stagnant for 3 years. And then post from 2015 to almost 2019, it has given 85% of upside. And then again, when the valuations become expensive and the earnings growth are not that much good, the small cap index often corrects. As we can see, it was roughly 57%, and the downfall was further increased as on March 2020 when COVID happened. As we can see, the bright red candle that is there. But post COVID, it gave a roughly 200% rally. Then again, there was a bit of stagnancy due to the Russia-Ukraine war, and after that it again gave 111% rally. But then again, the similar cycle which gets repeated is the valuations become overvalued and the earnings growth were not good enough. And now with the ongoing US Iran war, it is basically a wait and watch situation as to. And at the beginning of 2025 as well, if we can see, the valuations were expensive and the earnings growth was not good enough. And that with the current US Iran war that is going on, and the small cap index is still a bit kind of stagnating. So the key question here is not to ask whether you can invest in small cap or you should not invest in small cap. One of the main question is that can you stay invested? That can you remain invested even when the market falls 25%, 30%, or even 75% in case of a black swan event like 2008 crisis? Your psychological reaction during these corrections dictate your returns rather than your investment amounts or return expectations. If you don't have the risk appetite to stomach roughly 30, 40, even 70 at times percent decline, maybe concentrating too much in small cap is not a good idea, especially when the market volatility forces you to panic sell at the bottom of a cycle, because that is exactly when the growth of small cap, the market volatility, which often works in and helps even the small cap get great returns, it becomes double-edged sword, especially when the market volatility increases during negative situations and you're forced to panic sell. Because small caps are as volatile, their correction is also much sharper than the large and mid caps, and that causes them to fall even much more than large and mid caps comparatively. So that is a thing that one must keep in mind, and hence the strategic small cap exposure that is in your portfolio, it must be calibrated as per your personal risk tolerance and your liquidity time. And this is why your small cap exposure must be calculated as per your risk tolerance and your liquidity timeline, that when will you exactly need the money and what is your time horizon for the investment. So what does a smart investor does is that he looks at the portfolio as a whole. Small caps shouldn't be viewed in isolation. Instead of just focusing on a single market capitalization segment, be it large cap, mid cap, or small cap, even for that matter, an investor must consider a disciplined and diversified allocation strategy. Your ideal allocation should be mathematically grounded in three pillars, roughly. One is the risk appetite that you have. What is your risk appetite? Are you a conservative investor? Are you an aggressive investor? Are you a moderate or a balanced one? That matters. The financial capacity, that how much liquidity you have, how much money you can invest, how much losses that you can take. That is one thing. And another thing is the investment horizon. That what is your investment horizon? Are you looking for a short term, long term? If long term, how much long term? And if short term, how much short term? Depending on all those things, your portfolio should be constructed and rebalanced as per required. So, what does a well diversified portfolio look like? So, basically, a well diversified portfolio looks like when market capitalization is balanced. So, in a good portfolio, it is not only concentrated in large cap, mid cap, or small cap for that matter. It is created by maintaining a balance, by understanding the risk appetite, by understanding the time horizon, by understanding the goals of the investor, and taking all these three things into consideration. proper asset allocation is done in all the three caps depending upon the investor's needs. And that's the kind of portfolio that helps investor to navigate different market cycles, economic conditions, and capturing upside without exposing the investor to excessive down market. And to be put in a one liner, that should a person invest all of his funds into small cap, one must remember that the goal isn't to maximize the small cap exposure. It is to build an exposure or an allocation that you can stay invested in comfortably for the long run and which should make good returns for you. So diversification across market caps and appropriate exposure is what basically is a portfolio designed for the long term. Thank you.